You've heard it from him. Get help. All right, now we are going to move on. The government has been urged not to increase the tax rate for Kenyans, but rather expand the economy and renegotiate maturing debt to ease the fiscal reassures. Jimmy Mbogo spoke to Ernst & Young managing partner Anthony Muthusi on the debt pressure that the country is facing and the possible solutions to the same. Jimmy, good afternoon. What is the way forward?
Well, indeed, a very good afternoon to you too, Nyakundi. Yes, as you've rightfully said, we're having a conversation around the budget. Now, this is a sort of a prediction to what experts are expecting to come in the next budget. Now, this budget, as we have seen in the past, the budget continues to be a progressive budget. Last year, we had a 3.3 trillion budget. This year, we expect a 3.6 trillion budget. Now, out of the 3.6 trillion budget, we expect about 720.1 billion shillings to be financed through debt. Now, currently, one of the biggest headaches for government experts and for the CS Treasury has been the issue of the debt, maturing debt and debt repayment. This continues to be a headache, and we've seen over the last week the conversation being that government is broke and just trying to look at how government has been spending some of the revenues that they collect. Now, to help us understand what is currently going on in that space, what does government need to do with regard to our debt situation, I'm joined by Anthony Muthusi, who is from EY, and I just want to engage him and see what he has to say about some of the government debt. Now, Anthony, from where you sit, at the moment we are seeing a lot of debt pressures in the country. Now, from where you sit as an expert in some of these matters, what does government need to do to reduce the pressure that we're currently seeing?
Thank you very much, Jimmy. And I know there's been a lot of debate around the issue of debt recently. And it's estimated that our current debt to GDP is at about 65-67%, which is arguably very high compared to our neighbors in the region. Uganda is currently at 40%, and Nigeria is probably at 15-20%. So you could argue that it's a little bit stretched. However, I still think there is headroom for the government to be able to manage the current situation. For example, one of the levers the government should consider pulling is improve revenue collection. The other one, obviously, there is scope for us to rationalize our cost, reform our civil service or government expenditure. And the last one, obviously, is the issue of prioritizing capital programs, how we select our projects that we fund. We prioritize those that have got high impact from an economy perspective, etc. So there's still some room there. The other room, obviously, if debt service becomes an issue, the government could consider negotiating with creditors, longer tenors, for example, 30 years, 40 years tenors. That will reduce pressure on the current debt service level. Right. And obviously the other one would be obviously to think about how we can have a comprehensive restructuring if need be, but I don't think we are there yet. Okay.
Now, from where you sit, what does Treasury need to do to protect Kenya's credit rating, both at the local market and at the international market?
And like I spoke to that, one of the areas is continued economic growth. So as long as the economy is performing and growing, that will improve the outlook for the Kenyan economy in terms of the credit rating. The other one is around the issue of revenue mobilization, tax collections, and obviously the issue of reforming our expenditure, specifically the recurring expenditure, the scope for some improvement there. And what that will do is that it will help us increasingly begin to manage our deficit and balance our books, and that definitely would have an impact on our credit rating and an improved outlook.
All right. Now, one of the things that has been blamed for our current debt situation is the fact that we've had quite capital-intensive projects in the country. Is this something that the current government needs to do away with, or how do we go forward? Because again, at the end of the day, development has to happen and recurrent expenses have to be met.
I'm not sure we should do away with capital expenditure, because if we don't reinvest in infrastructure, that will affect economic growth in the future. So we need to continue to selectively, and I think the key here is, are we selecting projects going forward that have got a high impact on economic growth? I think that must be a priority. We also need to rationalize our capital projects. I think we've got too many that have stalled. Figuring out how do we get efficient around allocating capital programs, ensuring that the budget is actually absorbed into those capital programs, and that we are completing selected prioritized projects.
All right, Anthony, before I let you go, of course, we've seen countries such as Ghana default. Is defaulting an option for Kenya, and what are the ramifications of that?
Yeah, obviously I wouldn't recommend a default, but if assuming we are unable to mobilize enough cash to pay from our tax collections, we are unable to manage our expenditure, and we have got no choice but default, then I would suggest that we manage that properly, that we think through it, we forecast and be able to foresee whether a default is coming, and if a default is coming, we deal with it. Yeah. So at the end of the world, we negotiate with our creditors and make sure that we sort it out once and for all.
All right, thank you so much, Anthony, for speaking to KTN. And of course, Nyakundi, this is a conversation that will be going on for the few coming months, just to be able to analyze the budget and to see which sectors need to be prioritized. And of course, one of those sectors is the sectors of agriculture, just to be able to bring down the cost of food, which has been one of the key components that has pushed inflation to the current position of to the current status of about 9.2 inflation rate. So we'll be giving you more details in our subsequent bulletins, but for now, back to you.
All right, Jimmy, thank you for that information. All right, we've